So we have, over the course of time, answered a question a lot in client meetings, and that is the concept of dollar cost averaging. Dollar cost averaging, basically, you have a lump sum that you want to invest, and instead of, going ahead and plunking it right into a portfolio today, you spread it out in increments, let's say monthly, over a certain time period, 6, 12, 18, 24 months, whatever you happen to do. And in this conversation, we're talking about voluntary dollar cost averaging because a lot of us are dollar cost averaging into our 401k or doing monthly savings from our paychecks, that's when the money's available. But if you have a lump sum to deploy, do you voluntarily spread out the investment or do you put it all in at one time? And it tends to be a question you get more, I think, at certain market extremes, right? When markets are really volatile and maybe have sold off and there's a lot of concern, people ask it more. And when markets are at or near all-time highs, people tend to ask it a little bit more. So, depending on your lens, we could be day to day. I think we're more talking about this because we're at market highs, but if volatility picks up, we could get the question for other reasons. So with that, hopefully not too long of a preamble, walk us through, as a chief investment officer, when you get that question from new clients or existing clients who have a lump sum. I know you've done some research on it. What's your perspective?
Yeah, I think it's a great question and really is an interesting topic. So to kind of set the stage, say I go into a client meeting or a new client meeting, and it's someone who just sold their business, and as of this coming Friday, I'm gonna have $5 million in my checking account. What do I do? And it might come with it. I'm a little scared of putting it into the market because what if I put it all in and then the market goes down? Should we dollar cost average, say over 6 or 12 months, which would be putting 1/6 or 1/12 of that lump sum into investments, and 12 months from now you're at the fully invested portfolio. And in the meantime, what you do with the part that's not invested is it's in cash in a money market, which today has a little bit of a yield to it. Years ago, didn't. So that's dollar cost averaging in a nutshell. There was some research done, an interesting study published by Northwestern Mutual a couple of years ago, and they just did a back test. They just went through time and said if you did I think they did a 12-month dollar cost averaging schedule, how often do you call it win, meaning end up with more money, and how often do you lose, meaning you would have been better lump sum investing. And if you're dollar cost averaging into your final, call it destination portfolio, is 100% US equities, about 75% of the time, you're better off just investing in it day one. If your call it target destination portfolio, so 60/40, 60% stocks, 40% bonds, lump sum investing wins about 80% of the time, 80.22. 20% of the time, you would have done better trickling in over 12 months. So these are rough numbers, and the precision doesn't really matter, but it is more in line with intuition that more often than not, markets go up. So by sitting on the sidelines with cash, you're missing out. But they don't go up every day. They don't go up every year. They do go down from time to time, and that's when you would have been better off dollar cost averaging. But the punchline is the odds are against you when you dollar cost average. And that's to begin with. It gets a little more difficult for dollar cost averaging because, as you said, Sammy, with your intro, we tend to get these questions when people are concerned about markets, when there's uncertainty, when there's market volatility. It's, oh, there's a lot of uncertainty out there. Maybe it's around an election time, but frequently after a market crash. Oh, things are scary right now. Should I dollar cost average? When things are good, we don't get the questions as much. The topics don't come up. So the numbers I read off, call it a 75 to 80% win rate. That's a back test, assuming no emotions at all based on the scenarios. In reality, I think the outcomes are a little worse than that because people tend to ask for dollar cost averaging or ask the right questions that lead to implementing dollar cost averaging around market lows.
Interesting. So you get the question more at market lows, whereas I feel like sometimes I get them when markets are doing really well. But so let's focus on that then. We get them during times of market distress.
Yeah, so thinking about it, market uncertainty. If you have certainty around an investment, that's what a U.S. Treasury bond is. There's certainty around when the coupons are going to be paid. There's certainty around when it matures. and there's certainty around what it's going to mature for. And that's why it's called the risk-free asset. So as you get some level of uncertainty, take it beyond treasuries to a corporate bond, and um, that's where, maybe they'll default, maybe not. You get a little bit extra return. So I think there's a pretty clear relationship in markets between uncertainty and expected return. The greater the uncertainty, the more, call it a greater spread of outcomes, greater range of outcomes, the more questionable the future is. That's risk. And with higher risk should come higher return. On the face of it, immediately it is rational. When there's more uncertainty around outcomes, more uncertainty around markets, than dollar cost averaging, you'd say, well, that makes sense, that anything could happen. There's a lot of paths. This could get really bad or could, I guess, could be really good. Let's dollar cost average. But when there's more uncertainty, that's more risk, and that's a higher base case expected return. So that's more how I see it. It's typically around some event. Could be COVID, when COVID hit, like if it's late March of 2020, and you have that person who just sold real estate or business, it's a bit of a scary time to just lump sum invest, just put it all to work. Would have been a beautiful time to put it to work, say on March 20th. But that's more how I see it, where the odds are already against you. And then if you're seeing more dollar cost averaging when uncertainty is higher, when uncertainty is greater, when risk is greater, which again does make sense immediately from human nature. Like, oh, there's a lot of risk here. Let's be careful. Let's invest slowly. Let's trickle in. That's really when you want to lump sum invest. So it's got two things going against you: the back test, the base case, and then I feel like human nature takes you there when you really shouldn't be going there.
Just to summarize those 2 points, the monthly returns in the market more often than not are positive, right? So if you're sitting out of the market for a series of months, your expected return is not going to be as good as, plunking it all in. And then your second point, I think, connects to some of the data you've shared with us around rebalancing, in that, big sell-offs, 20% plus sell-offs are buying opportunities. They're not, times to kind of slow play into the market. So that being said, we still do dollar cost average for clients when they ask, and we've had a good conversation about the pros and cons. Because to your point, they may be new investors. There's times of uncertainty. They need to sleep at night. The better thing is to get the money in the right place long term, and if that's what it takes to get you invested, I think that's a fine strategy. The odds are that it does work against you.
Yeah, maybe one thing to add, I'll just share a quote I saw the other day that's interesting. I'm not a huge tennis fan, but this is from Andre Agassi, the tennis player I think he was in the 90s. He said, "Now that I've won a slam, I know something very few people on earth are permitted to know. A win doesn't feel as good as a loss feels bad, and the good feeling doesn't last as long as the bad, not even close." And that's the end of the quote. And there's a very direct tie, whether it's winning and losing in tennis or winning and losing on investing. There's a lot of research that shows that losing money hurts a lot more than making money feels good. So being aware of, that our clients are humans. I'm not a, quantitative robot with no emotions. So I do need to be able to connect to that. That is real, and that's kind of the dynamic. Now, do clients want us to give them the rational, logical, quantitative advice, or do they want us to be aware and tuned into their emotions and know that they wouldn't want to put their $5 million to work, and it going down 10%, 20% is unacceptable. So there is that human connection that can support dollar cost averaging. But I do like to stick to the numbers and make sure that we're going into it eyes wide open.
Yeah, no, absolutely. It's a great recap.